All right, let's dive in. Today, we're going to break down something that can be a real headache for anyone in international trade: customs valuation. We're going to demystify how the value of your goods is officially calculated so you can unlock the true costs of bringing them across the border.
You've probably been there, right? You get an invoice for your shipment, you think you know the cost, but then the final bill from customs comes in and it's higher. So what gives? Well, the thing is, that invoice price, it's really just the starting point.
So, that gap, it's not random. It exists because there's a formal, global system designed to figure out what your goods are actually worth for the purpose of duties and taxes. It's a system that goes way beyond just the number on a piece of paper. And that official process, it has a name: customs valuation. This is the mechanism that customs authorities all over the world use to get a consistent, taxable value for your imports. It's literally the number that all your duties and taxes get calculated from. And look, this isn't just some made-up rule that changes port to port. It's a global standard overseen by the World Trade Organization, specifically to create a level playing field. The whole idea is to stop customs from just slapping any old number on your shipment. It has to be fair and uniform for everyone. Okay, so why do you, as an importer, really need to get this right? Because honestly, getting this right, or getting it wrong, is a huge deal for your business.
For starters, it hits your bottom line directly. Getting it right means you can optimize your costs and you won't overpay duties. Then there's the legal side. Correct valuation keeps you compliant, which helps you avoid some really painful audits and penalties down the road. And when you put those two together, you become way more competitive on the global stage.
So how do they actually figure out this value? Well, the WTO has laid out a super clear step-by-step framework. The best way to think about it is like a ladder with 6 rungs. And the rule is you always have to start at the very top. So here they are, the 6 steps on that ladder. You start with the most common one, transaction value. If for some reason you can't use that, you move down to the value of identical goods, then similar goods, then a couple of calculation-based methods, and only then, at the very bottom, is the fallback method. Now, this is the part you absolutely cannot forget. You have to follow these steps in this exact order. You can't just skip a step or jump to the method that gives you a lower duty payment. You start at 1, and you only move to 2 if 1 is impossible. It's a strict one-way street down the ladder. Okay, so method 1, the transaction value. This is the big one, the one you'll use most of the time. It's based on the price you actually paid for the goods. But, and this is a really important but, it's not just the price on the invoice. You have to add certain things to it, like the cost of international freight, or royalties, or certain commissions. Let's make this real. Imagine your company buys 1,000 laptops for an even $500,000. Great, but the international shipping costs you another $5,000. Well, for customs, the value isn't $500,000, it's $505,000 because you have to include that shipping cost. But what if you can't use method 1? Maybe there wasn't a sale, like it was a free sample. Or, and this is a common one, maybe the buyer and seller are related companies, and customs isn't sure the price is a true arm's length value. You know, is it a real market price or some special family discount? In those cases, yep, you guessed it, we move down the ladder. And that brings us to the next rungs, methods 2 and 3. These are all about finding comparable sales. If your own price doesn't work, customs will look at the price of identical goods that were recently imported. If they can't find any of those, they'll broaden the search to similar, interchangeable goods. Okay, so what if there are no identical or similar goods to compare to? Well, we keep climbing down to methods 4 and 5. The deductive method is kind of like working backwards. You start with the price the goods are sold for in the import country and subtract costs. The computed method is the opposite. It builds the value from the ground up, starting with the producer's costs. And if all else fails, if you've tried everything and none of the first 5 methods work, you land on method 6, the fallback. This is your last resort. It's more flexible, but it's not a Wild West situation. The value still has to be based on reasonable means and can't be just an arbitrary guess. So we've got the ladder down, right? But here's where things get tricky. This is where customs valuation starts to overlap with your company's internal accounting, especially when you're dealing with transactions between related parts of your own company. It gets complicated fast. And this is a perfect example: customs valuation versus transfer pricing. They're both about putting a price on goods traded between, say, a parent company and its subsidiary, but they're kind of pulling in opposite directions. Customs authorities often want a higher value to get more duty revenue, but your corporate tax people might prefer a different value to align with tax laws. Balancing those two is a massive strategic challenge.
And all this complexity, it creates some pretty common traps. Things like completely forgetting about costs that are on a separate invoice, or getting confused about what's dutiable and what's not. Another big one is not being able to prove that your internal price is fair, or just not having the paperwork to defend your valuation choice if you get audited. Trust me, these mistakes can be super costly.
But here's the good news. If you can get a handle on all this and navigate those risks, you can actually flip this whole thing on its head. You can turn what feels like a burden into a real strategic advantage for your company.
And this really shows you the payoff. When you get valuation right, you win in 3 key areas. 1, you optimize your costs by saving on duties. 2, you stay compliant and seriously reduce your risk. And 3, those 2 things together make you a much stronger, more competitive player in the global market.
And that's the key takeaway here. The goal isn't to scheme your way to the lowest possible duty. The goal is accuracy. It's about paying the correct amount, not a dollar more, not a dollar less. That's what true efficiency in global trade looks like. You know, there's a great quote that just nails this idea. Effective customs valuation isn't just about compliance. It's a strategic lever for cost reduction and global competitiveness. It's so much more than just filling out forms correctly. It's a tool you can use to make your business better. It's really about flipping the script and turning a mandatory process that everyone has to do into a real opportunity for your business to shine. So I'll just leave you with this one question to chew on. After everything we've talked about, from the valuation ladder to transfer pricing, is it possible that your business might be leaving money on the table at the border?